MBA as a fresher from IIM Calcutta. So I've done my MBA from IIM Calcutta with majorly stress on finance subjects in my second year. I have worked as an equity research analyst in Bank of America, and then post that I am currently working as an investment banking analyst in a firm called Inter International. So I was also an options trader during my graduation days, and I used to trade index options. So that's it about me. So I'm basically a learner like you, very uh, in a very similar position which you guys are in. So I was also an engineer who had like a very shallow knowledge in finance, but in the last 4 5 years, having gone through all the courses and the practical applications in life as well, I've got a hang of it right now. So I would try to pass on as much as possible in this session. So we'll be covering a few topics today. So first of them will be bonds, and then we'll followed by fixed deposits, and then we'll also look at some of the uh, core investment strategies like gold and what sort of prices and market dynamics are affected. And lastly, would be having a look at the Indian taxation systems and certain strategies for saving taxes or how to file taxes for uh, new income tax earners. So that way, we'll try to get as much as covered in the next 1.5 hours. So I hope everyone is familiar with the term fixed deposits. Uh, I'm sure that we must have all solved questions in eighth standard or ninth standard about fixed deposits and interest rates and stuff. So I won't go into the basics of it, but I would more take this session from a practical point of view as to uh, where you can invest in bonds and how in real life the bonds work. And also I'll be taking you through the portals from which you can start investing. Okay, so coming to the technicalities of it, we'll be looking at terms like inflation, interest rates, tenures, and liquidities of bonds. So, firstly, we have to understand the concept of inflation. So, inflation basically means that for the same amount of money, the purchasing power of the money decreases as time progresses. So, for example, 100 rupees in let's say 1990 is not the same as 100 rupees in 2023. So if you could afford n number of goods with a 100 rupee note in 1990, you can maybe afford n by 5 or n by 10 number of goods in 2023 with that same 100 rupees. So which means that while the amount has remained the same, the purchasing power or the effective value which you can get from that amount has decreased, and this is called inflation. So there are a few ways to measure inflation, and the very basic is we take a basket of goods and for them we calculate the inflation. So this is called the CPI inflation, the consumer price index inflation. So now these baskets of goods usually contains day-to-day items. Then we'll look at the impact of inflation on how our fixed deposits are affected and also bond yields. So for bonds, there are some basic terms which we need to know about before starting off. So these are coupon rates, yields, and maturity. I'll come to one by one. So coupon rate of a bond basically means that the percentage you will earn from that bond annually on its principal. So for example, if there is a bond with a principal of 1,000 and the coupon rate is 6%, so annually you're expected to make 6% of 1,000, 60 rupees in coupon payments. The reason why it is called coupon rate is because initially when bonds were issued, there were coupons attached to the bond. So you would have to submit these coupons to the issuer of the bond, and in return you would get the money, and that is where the term coupon comes from. Now for the bond maturity. So the bond maturity is the time period from which I, as an issuer, issue the bond to you as a bond holder will hold it. So for example, if there's a 5 year, we say the tenure of a bond is 5 years. That means if you put in the money to the bond now, 5 years later the bond matures, and you get your whatever interest and principal payments that are due back. And next is the yield to maturity. So the yield to maturity is nothing but the net effective return in percentage that you're making from the bond. So you can say that, for example, today you buy a bond for 1,000 rupees. and you would get some coupon payments in the next 5 years, over the course of next 5 years, and then you would get some principal amount back at the end of 5 years, which we call a balloon payment. So the yield to maturity effectively means that how much have you made on that 1,000 rupees that you have invested today at the end of the 5 years. So basically, that's the yield to maturity can also be defined as the required rate of return that you need as an investor to put your money into that bond. Okay, so now we would like to know how the interest rates impact bonds and FDs. Now, very simple situation here. So, a couple of years back, when COVID had struck, then most of the central banks across the world had cut their interest rates. So, what that means is banks will start giving you out money at lesser rates of interest. So, as a borrower, you are at an advantage if the interest rate decreases, since you can get your loan at a smaller interest rate. But at the same time, if you are someone who has done FDs during that point in time, then the interest that you are getting on your FD is also reduced, since there is an overall reduction in the interest rate. So as a borrower, you would always want a lower rate of interest, but as a lender, you would always want a higher rate of interest. So when we are investing in a particular instrument, we usually tend to favor a higher rate of interest so that we get more and more interest on that. Now imagine this situation. For example, today you have invested in a 100 rupee bond and it promises to pay you, or let's say in a FD, 100 rupees FD you have done, and it promises to pay you 7% interest. Now, tomorrow, if the interest rate starts going up to 9%, then you would probably regret that if you had waited for a little bit longer, then instead of getting 7% interest, you could have done it at 9% interest. So, which means that if the rate of interest has increased, then the bond which you had previously bought is now cheaper. Because, for example, if the rate of interest is 7% today and you have bought a bond for, let's say, 1,000 rupees bond, so you would essentially get 7 rupees out of it at the end of the year. But tomorrow, if the interest rate increases to, let's say, 14%, then to make the exact 7 rupees, you have to invest only 500 rupees. So therefore, when the interest rate increases, there is a reduction in the price of the bond. The same bond starts to be lesser valuable if the interest rate increase. But similarly, if the interest rate decrease, then that will increase the price of the bond, since that bond will become more expensive. So therefore, remember that bonds are essentially inversely proportional to the overall interest rate of the economy. So this can also be told in this way, that if I am betting on the fact that interest rates will go down in the future, then I would ideally want to buy the bonds right now. Because what will happen is, if interest rates go down, then the price of my bonds will go up, and then I can later sell the bonds for a capital gain, for profit. So that's exactly what I'd explained. So the effect on bond issuers is that when interest rate rises, the issuers will have to issue the bond at higher coupon rates. So which means, as an investor, it's an advantage for me because I'll be getting higher coupon rates. Okay, and now coming to just for additional information, the effect of interest rate is across the whole finance world. So whatever product you see in the world of finance, be it bonds, be it stocks, be it debentures, all of them are basically affected by interest rates. So just like for bonds, an increase in the interest rate would decrease the bond prices. Similarly, usually for the share market as well, or for the stock market as well, an increase in the interest rate is actually hampers the stock market in a negative manner. Because what happens is, when interest rate increase, the companies will have higher borrowing cost, higher financing cost. They will have to give more interest, and that affects their PNL. So usually the PNL of companies which are capex capital intensive, they tend to have a higher interest expense, and therefore their profits go down, because of which the stock price goes down. So for stock markets as well, a decrease in the interest rate is always a favorable environment rather than an increase. The only exception to this is banks. So now, understanding the role of tenure in bond investments. So you can invest in different type of bonds. It can be something of a short tenure. Usually we define short tenure bonds as 1 year to 5 year bonds, or it can be something of a medium tenure, which is like 5 years to 10 years. Now there's no standard formula for this, but this is usually the standard accepted definition across. And the longer term bonds are usually ones beyond 12 years. So if we want to understand why the tenure is important, it's because for the same bond, or for exactly the same bond issued by the same corporation, a bond with a higher tenure, for example 10 years or 12 years or more, would more likely have would most likely have a higher rate of interest. That is because you are taking a longer term bet as an investor, which means there is more uncertainty. The longer the time horizon, for example a 12-year lock-in period is a higher uncertainty period than a 5-year lock-in period. So to compensate you for taking that additional amount of risk, the rate of interest offered to you will be more. So always remember that usually long-term bonds, I'm talking here usually, and I'm not saying in all cases, because there are exceptional cases where longer-term bonds might have lower interest rate than shorter-term bonds, which is also called the yield curve inversion. So that usually signifies recession, but that's a different thing that doesn't happen in a normal economy. In a normal economy, it's always the case that the longer-term bonds will have a higher rate of interest than the shorter-term bonds for the same issuer for the same quality. Okay. Now, there's one more important thing in bonds. It's the fact that there's something called liquidity. Now, in India, typically, so before that, I let me just define the term liquidity for you guys. So, liquidity here refers to the amount of buying and selling activity that goes on in any market. So, if we tomorrow go to a market, let's say any market, not just financial markets in general, but in general, any market, where you see that there is only one shop and you have to buy a product from it. So the problem here is that if there is only one shop, that means there is only one person to sell to you, which means that whatever price he quotes you, you will have to take that price. If you really want to buy that product, you have to take that price. But when the same thing, if there's a marketplace where there are 3 or 4 shops offering the same product, then you have a better liquidity in the sense that you don't need to accept the price that one quotes. You can have two, three, four quotes from different people, and you can get the best price. So basically, whenever there is for any the health of any financial market depends on the amount of liquidity. So if there is a higher amount of liquidity, then there are chances that you will get it at a better price. So we always prefer higher liquidity in bonds. Now, usually in India, the bond market is quite underdeveloped as compared to the other countries like US or the European countries for that matter. So in our country, bond markets mostly are governed by RBI, and we can usually find liquidity in the standard government bonds. But apart from that, from the corporate bonds point of view, we usually have the top corporate bonds like the top Nifty 50 stocks like Reliance, Tata, having enough liquidity. But beyond that, there is not much liquidity in other bonds. So you should try and avoid trading in illiquid bonds, because that would mean that either you have to exit at a price which is not fair, which is not the market price, since there are very few amount of sellers, or you don't get an exit at all. So always try to trade in any liquid instruments. Now, let's discuss some of the factors affecting the bond prices. So the first factor, as I told you, is interest rate. That bond prices and interest rates are inversely proportional, and I explained the logic for that. The second is the credit worthiness. So for any bond, the issuer's credit rating is very important. If you think that the issuer has a probability to default, then you would want a higher compensation for that. So therefore, it's the same as lending out money to people. That's how banks lend out. So if you have a good credit score, if you have a good track record of returning back people money, then more people will trust you, and they will be ready to give you the money at lower interest rates. But if you have a track record of defaulting, if you have a track record which has previously shown that, or maybe you have a financial condition which makes the lender doubt that whether you will have the credit worthiness to pay him back or not, then in that case there is always a higher compensation required by the lender to give you the money. Hence, there is a trade-off. So, as an investor, you should not be investing in bonds of corporate, or let's say corporate bonds of companies which are stressed out. While it's very tempting because you will get higher rate of interests, but it's at the same time a risk. So, for example, the safest bonds in the world are considered to be the US Treasury bonds. That's because US government hasn't default ever, and they won't default because the simple reason being, if they were to default, if they come on the verge of defaulting, they would just print extra money and they would pay you back. So that would increase the inflation, but that wouldn't essentially default. So therefore, in any country, the government bonds are usually the most safe rated bonds. So if in Indian context as well, the government of India bonds, the central government bonds, are the safest bonds, and therefore, being the safest bonds, they offer you the least rate of interest. Now, as you go higher up, as you go to the corporate bonds, the rate of interest that you get increases. But then, with that, the probability of default, or the probability of not getting your money back at all, also increases. Next up, there's a supply and demand. So for any bond, again, there is normal supply and demand, just like any other market commodities. So there might be situations when people might flock to the bond markets more. People might think that okay, stock markets are not going to perform enough, or okay, I might as well park my money in bonds. So in that cases, when there is an increased demand for bond markets, then you would usually find that bond prices will have good liquidity and good supply and demand factors as well. So you can probably understand, okay, this bond is in demand, and therefore the prices of this bond will go up in the longer run. Well, economic health is another factor that affects. So GDP, unemployment, these type of factors affect it. So now this can be connected to the interest rate. So economic indicators like GDP, if there is a strong GDP, if there is quarter on quarter growth is high, then you may think that in the long run the central bank will increase the interest rates, and you can link this to the interest rates. So higher the interest rate, lower the bond prices. Next, the purchasing power. So what happens is, if inflation increases, then the future payment that you will get, the power of the payment decreases. So for example, if the inflation is very high, if 100 rupees is losing its value so fast, then the future payments that you will be getting will also be losing their value, and therefore the bond prices will decrease. So for example, if somebody has bought a bond in 2010 that will pay him 1000 rupees annually, now in 2023, that value of the 1000 rupees, the commodities that you can buy with 1000 rupees, has decreased because the inflation has increased significantly over the years. So therefore, when this happens, you must remember that the bond prices will be reduced. Okay, another thing is maturity. So as I told you before, the time to maturity is important. Longer the maturity of the bond, longer the time to maturity, the more you will be seeing that the price will be, the more the coupon payments will be. That's because when there is a long term contract involved, there are two types of risk. A, you have the uncertainty risk over the period, and B, you also have something called the interest rate risk. So interest rate risk is, so if you are locking in your money for a longer term, in a 10-year or a 15-year bond, then in between, if the interest rates significantly decrease or significantly increase, then you actually have your money locked in, so you can't invest that money anywhere. So therefore you have taken an opportunity cost, right? And therefore you have to be compensated for that. The fact that you have locked in your money there 10-15 years, where you know that the interest rates can change. Next up, we have something called callable bonds. So this is not. I don't know if you will be able to understand this or not, but this is just for an extra part of it. The callable bonds are basically, so there's something called an call option. So in call option, what happens is you get to buy the bond at a certain pre-agreed price, even if the market price of that bond has exceeded. So for example, if I have a callable bond of 100 rupees, and the call price that I have set is 90. So even tomorrow, if the bond is at 120 rupees in the market price, I can still get it back for 90 rupees. So that's called a callable bond. So callable bonds affect both the bond price and the yield. So it decreases the bond price, because whenever the bond prices will increase, as an investor I want to sell it for a higher amount, but since someone else will be able to buy it at a lower amount, so that's a disadvantage for me, and therefore the prices of callable bonds are usually lesser. Liquidity, as I said, so more the liquidity in a market, it's always good for all the financial participants. As a buyer, I'll get the bond at a better price. So more the liquidity, lesser the bond price. Now there is something called forex rates. So if you're buying a forex bond, if you're buying a bond in a foreign currency, so as an Indian investor, if I am buying a bond in, let's say, US dollars, okay, so in that case there is something forex also comes into play, which means that since I am buying a US dollar bond, so the coupon payments that I'll get, or the payments, or the overall principal payment at the end which I'll get, will be in US dollars. Now let's say the Indian currency keeps on depreciating. So for example, rupee was at 50 rupees per dollar during the 2012-2013 period. Now 10 years later, it has come to 83 per dollar. So let's say if I were to enter in a bond agreement in 2013, in a US bond agreement, which will pay me $10 every year. So imagine this, in 2013, I was getting $10. That was around 500 rupees. So now in 2023, that $10 is actually 830 rupees. And hence, you have to understand that if the currency starts, if your currency, the currency in which you have invested, which is US dollars, starts appreciating or starts getting stronger, that means that you will be at an advantage as a bondholder. So that's how forex affects. Next up is the investor sentiment. So sometimes investor sentiments, for example, if there is a impending news about a certain type of company and that company has issued some bonds, then that also affects the bond prices. So, for example, Adani had issued bonds a year back. Adani gas bonds were trading. But when the news of Adani and Hindenburg came out, where Hindenburg had alleged that Adani had some problems in their operations, they had some weak financial statements, then a lot of investor sentiments had dropped, and people who owned Adani bonds wanted to get rid of those bonds at very, very low prices, since they were afraid that those bonds might default. So that basis the news, those bond prices crashed overnight. So that's where investor sentiment comes into play. Although later on it was clarified that none of the operations were in problem, it was later issued by the group, but temporarily those investor sentiments had set in the market. Okay, so the types of bond we have here. So in India, municipal bonds are very rare, but government bonds and corporate bonds. So in government bonds, we have got both central government bonds and state government bonds as well. And in corporate bonds, we have different types of all types of corporate issuers issuing their bonds. So I'll just show you something here practically where we can find the government bonds. So there is a website called RBI Retail. Okay. So RBI Retail Direct.in. This is from where this is a kind of a portal from where which you can buy government securities. Okay, you can buy government bonds as well as sovereign gold bonds and stuff. And also, if you are not comfortable in directly dealing in bonds through RBI Retail, there are plenty of mutual funds available which invest in corporate bonds. For example, ICICI corporate fund or Axis corporate fund and stuff. So they also do the same thing. They basically pool your money, and just like normal stock mutual funds invest in stocks, you get to here invest in corporate bonds. So I'll just show you examples of corporate bonds as well. For example, I am typing out Reliance corporate bond. See, see, Reliance Industries 9.25%, 16 June 2024 corporate bonds. Just give me a minute. हाँ यस सो बेसिकली सो रिलायंस के जो बॉन्ड्स है जैसे दिस इज रिलायंस बॉन्ड्स सो यू कैन सी दैट 9.25% is the interest rate. Okay. uh, Now if you want to check the credit rating of a bond or the credit rating of any company, you can simply type the company name and then credit rating, and you have plenty of credit rating sites like ICRA, CRISIL, etc. So for example, Reliance has got CRISIL. So you would see something here like the CRISIL AAA stable, CRISIL A1 plus. So this basically represents the probability of the bond being secure. So AAA is considered a very, very safe bond. So you might say that, okay, with a 99.7, 19.8% confidence that Reliance is not going to default on their bonds. So on. So Government of India has the highest AAA plus in terms of the credit rating. So usually CRISIL and all, they cover all the main major Indian ratings. So just to check whichever company you're investing in, you can get the credit rating from here. Okay, so this was about the corporate bonds. Next up we have, yeah, so now we have the fixed deposits. So as we know, we've got bank fixed deposits, post office time deposits, and corporate fixed deposits. So for fixed deposits, the again it's very similar in terms of the bond and fixed deposits. Both are similar in a way that they assured you of a payment, but while they assured you of a payment, there's always an opportunity cost since you can't get your money out in the time or the tenure in which you have invested the money. So you can't get your money out in most cases. So the benefits of investing in bonds or fixed deposits are same. So the first benefit is that they obviously offer you a regular income stream in terms of the interest payments or the coupon payments that you're getting, and it's also a diversification because if you're someone who's investing across all the financial instruments, for example stocks, mutual funds, etc., then bonds of course will give you additional diversification. The risk, as I said, is always the interest rate risk, which is the major risk, that whenever you are locking in your money in something, the interest rate risk remains, that if the interest rate tomorrow increases, then as a bondholder, you would feel that you have missed out. You have missed out in the sense that if you could have held on to your money a little bit longer, you could have invested it at a higher interest rate. So that interest rate is more like an opportunity cost. Okay. And next is the credit risk. So I usually ask people not to invest in such instruments where there is a significant amount of credit risk. For example, if you think that the company might default, or in general, if you are lending out even to your friends or nearby tier ones, make sure that you don't run into credit risk. It's not something you don't want people to default on your money. So you might lose the entire principle of it in trying to earn some little interest of 8% or 10%. It's never a wise decision to lose out on the principal. And the inflation risk also remains. So inflation risk is like that if the inflation starts increasing significantly, then you could have had invested in a better instrument. And tax considerations. So for bonds, I'll come to this later in the tax part as well. What are the tax considerations of the profits that you have made on your bond or the coupon payments that you're getting on your bond? Okay, so strategies. So always select the right bond, and as I've showed you, try to go through the grade ratings of that, the financial stability of that bond. So as I said, grade ratings comes under CRISIL, under ICRA, under Fitch ratings. So you can refer to any of them, and these are all free grade ratings available throughout the internet. So always read up on that and try and understand that if your company has whatever company bond you have invested in has the required resources to pay back your money. Diversification is important as well. So don't try and put all your money into government bonds since you'll be getting a very low rate of interest. At the same time, don't put in your money entirely through all the corporate bonds. Or even if you're doing it for corporate bonds, don't put it into the corporate bonds of only one company. Always diversify, since you never know if you're taking a bet on just one particular issuer, then if the issuer defaults, then you lose your entire money. So try and diversify. Don't put all your eggs in the same basket. Now the tax efficiency part. So for tax efficiency, again, I'll come to this later. How to optimize the returns from your bonds and the interest that you earn from it. Okay. So next let's go on to gold. So for gold, I'll start off by telling you the history of how gold was pegged against the currency. How before the days of Richard Nixon, the U.S. president, who decided to do away with gold pegged against U.S. dollars, how gold was used in currencies. So first and foremost, as we all know, gold is a metal in which we usually use it for jewelry and stuff, and people in middle class love it as and and people in the older generation would probably tell you that it's like an asset for the entire family, and its value never degrades. It keeps on increasing. A large part of it is actually right, what they say, but let's just look at it from a financial perspective. Okay. So the simplest way to invest in gold, apart from going out there and buying physical gold, is sovereign gold bonds. So sovereign gold bonds basically means that bonds which are issued through RBI, and it's directly by the government of India, and you can invest in those gold bonds for a certain tenure. So these are basically government securities, which means that RBI issues them on behalf of the government of India, and it's the same as owning the physical gold. So the price of the sovereign gold bond is exactly the same as 24 karat gold. Okay, so whatever the market rate that's going on right now, so this is defined by something called IBJA, okay, Indian Bullion Association, which defines the rate of 99.9% pure gold, 24 karat gold, and the whatever the market price is today, that's exactly the price of your gold bond in RBI's website. So you can invest in this gold bonds for different tenures. The minimum tenure is around 6 years, and it goes up to 12 years as well. So I'll show you an example of how RBI SGB works. So you go to Google and you type RBI SGB. So here's the sovereign gold bond. So this is basically the issuance of gold bonds. So the latest was December 11, 2023, and you can invest in this sovereign gold bonds through several entities. So it can be done through commercial banks, through post offices, through stockholding corporations, through brokers, through NSE, BSE, etc. So I'm sure whatever bank account you have, your bank will definitely provide you services to invest in SGB. So all of them do it. Okay. Now you have to just check out when does this. So it's usually happens twice in a year that you will get two sort of SGB schemes coming out. So you have to invest in any other two. So if you look at this document, so this was the date of subscription. The next one is February 12 to February 16, 2024. Okay, so now for the interest earnings. So the good part about SGB is, unlike your physical gold that lies in your cupboard, SGBs will pay you 2.5% per annum interest annually. But this is a simple interest and not a compound one. This is a simple one. So basically, whatever the price of the gold is, whatever the gold price appreciation is. So for example, you have invested gold SGBs in 2018 when gold price was around 35-40,000, and in 2023 it's around 60K. So apart from the appreciation that you've had in 20,000, you will also get that 2.5% throughout the 4 years annually in your invested amount. And this, by the way, 2.5% that you're getting is tax free. So you won't be taxed for this. So you might now think that it makes absolute sense to go out there and not buy physical gold as an investment. Of course, if you want to wear it, you wear it. But as an investment, it's much cleverer to buy some SGBs, because you would get the additional 2.5% interest as well, and the appreciation in the commodity, whatever you're having. Now, redemption and liquidity. So, SGBs, as I told you, comes in with a lock-in period. So, for example, the last one came in with a lock-in period of 6 years. If I invest now in February 2023, I won't be able in 2024, and I won't be able to get it before 2029 or 2030, depending on whatever the lock-in period is. So now it's currently 5 to 6 years. It's also liquid if you trade it on stock exchanges. So there is something called
Stocks
gold
and mutual
bees on
funds.
stock exchange. GOLDBEES.
50K.
Gold bees you will find on your broker's app, whatever you're using. So on gold bees you can trade gold. It's directly the same as gold. So if you think that okay, in the next 6 months the price of gold is going to increase, so I might buy it today and sell it 6 months later, you can do it through gold bees. Now let's look at some of the factors that influence the price of gold. So, firstly, demand and supply dynamics is constant across everything in finance. So, tomorrow, if there is some sort of a windfall supply through mining or whatever, if the supply starts to increase drastically, then of course the price will fall. Or if the demand starts to increase for some reason, then the price starts increasing. But let's look at some of the factors in more nuance apart from demand and supply. The major factor is inflation. So gold is often said to be a hedge against inflation. And the reason why gold is hedged is because whenever the purchasing power of a currency decline, okay, remember that inflation basically means that the purchasing power of that same currency declines. Then gold, which is by the way limited in quantity, will also have an increase in the value. Since the purchasing power of that particular currency has declined, so the amount of gold remains the amount of gold in supply doesn't increase as much as the money in the system increases, and therefore gold starts to get more expensive. People are ready to pay more for that same amount of gold. Hence gold is sometimes thought to be a hedge against inflation. If inflation starts increasing drastically, you would rather have gold to protect you from it. Next is interest rate. So when interest rates are low, the relation of gold with interest rates is a bit tricky to understand. In a sense, I'll try to make you explain you that when the interest rates are very low, then the opportunity cost of holding the gold is also low. Okay, that makes it more appealing, and therefore gold will become more expensive then. But when the interest rates are higher, people will not try and buy gold. People will instead try to put their money on fixed deposits and other instruments, and therefore the gold prices will decrease. So the crux of it is higher interest rates means I will park my money in bank or in bonds or whatever, and not in gold, and therefore the demand for gold decreases, and therefore the price of the gold decreases. But lower interest rate means I don't have any other place to park my money because the bonds are not paying me enough. So I would rather park it in gold, and therefore the demand for gold increases and the price increases. So it's pretty much an inverse relation. Okay. Next up, the currency strength. So currency strength used to be, so since gold is usually priced in US dollars, so the change in the strength of the dollar can influence the gold price. A weaker dollar will lead to higher gold prices, and a stronger dollar will lead to lower gold prices. Geopolitical events, another important part. So any political instability or conflicts like a Russia-Ukraine war or stuff, okay, will always drive investors towards safe investments like gold. So remember, gold is a very bearish asset in the sense that whenever people perceive the economy is about to go down, or people perceive that there's a genuine uncertainty and unrest in the system, then people tend to flock towards these very safe currencies, very safe entities. So gold is one such. So gold and Japanese yen. Japanese yen is another instrument in the world of finance, which is usually considered a barometer for understanding how much the instability is. In very turmoil situation or unstable situation, gold would be absolutely a safe haven for all the investors. Next, central bank policies. That is also important since central bank policies decide what the interest rates will be. So I would also say that central banks like Reserve Bank of India, they tend to issue this gold bonds, the sovereign gold bonds on behalf of the government. So it also depends on how much gold the government is buying and selling in the market, in the open market. That will also influence. So if the government is letting out or dishing out more sovereign gold bonds, that simply means the government wants to sell their gold, which means that they want money in behalf of gold. So that would actually decline the price of the asset. Next is jewelry and industrial demand. So jewelry and industrial demand will be very intuitive. So in seasons when jewelry and industrial demand is in high, of course the gold prices will go up. Mining costs are also very intuitive to understand. If the mining costs are high, then the expenses for getting out that gold will be higher, and therefore the price at which the miners will want to sell it will also be higher. Market sentiment will simply refer to, as I said, if the economic conditions are unstable, then people will flock towards gold. Then the market sentiments will say that gold prices will increase. Gold ETFs and investment demand. Again, gold ETFs. If gold ETFs are too flocked in the market, then people would want to trade in those gold ETFs, and this would increase the liquidity and would give you a better price. Seasonal factors include again seasonal demand and supplies. There might be some seasons when the need for physical gold is more, and these are seasons when the gold prices will typically tend to spike up. But such spikes are usually short lived, and in the longer run, these are not the factors which influence. So seasonal factors won't be a long term factor for driving the price. Technological advances, this simply means that if we find out better technologies where gold is excavated in a more efficient manner, where the mining costs go down, then obviously the prices of gold will also go down, since we can get in more gold for the same price. Now, gold as an investment, what are the advantages of it? So there's a stored value, which means that if you buy a gold today and keep it 30 years down the line, then no matter what the inflation is, as and when the inflation increases, the gold prices will also roughly tend to stay the same. So, for example, if you had bought 10 grams of gold in 1990s for X amount of rupees, then pretty much in 2023, if you sell that 10 amount of gold and get whatever you're getting, so let's say 60K you're getting, that is equivalent to whatever X amount of rupees you had invested in 1993. So it pretty much keeps locks in your money against inflation. So if you want to, like, if you have today like 5 crores and you want to get that same 5 crore worth of money in 2053, let's say, so of course the best way is buy 5 crore gold and wait for 2053 and then sell whatever gold you have with that 5 crore, and whatever money you're getting in 2053 will be roughly equivalent to what 5 crore is today. So basically you have locked in your money against inflation. Portfolio diversification. So as I said, always try to build a diversified portfolio with stocks, bonds, debentures, and gold. And liquidity and accessibility. So gold is very very liquid. The only good thing about gold is it can it can uh, you won't find any liquidity issues throughout. So no matter which part of the world you're going, the liquidity of gold will always remain the same, and it's always traded with the with same amount of uh, you would find active markets everywhere in the world, and it can be very easily converted to cash. Okay, now let's look at the historical performance of gold. How much sense does it make to invest in gold? How much sense does it make to invest in a bond or in a stock market? So for this, I'll try to take you practically to what gold prices have been. Okay, let's go. So this is a site called Trading View. So this basically gives you the price of any asset. I'm going to type out gold. So this is USD, but I'm going to, it doesn't matter, for gold, no matter whatever the country is, whatever the currency is, it's throughout the same across the world. So right now it's showing 2048. Let's make this a yearly chart. Okay. Very simple exercise. Uh, I'll just try to find last 20 years, whatever the gold price have increased. Okay. So this I would roughly consider 2002 to 2020, 2003 to 2023 is my time period. 2003 beginning it was around 355, you would say, and now it's around 2050. So let's do a simple exercise. 2003, 355, 2023, it's 2048. Okay, so 20 years with this. So I'm just gonna calculate the CAGR. So my money has gone up by 5.76 times, but I would just like to calculate the CAGR here. So what I'm gonna do is this 1 by 20. I hope. Excellent. Just a second, I missed it on the bracket. Okay, so this is a CAGR of around 9.1%. Okay, so roughly it's given me 9% return in the last 20 years. Now let's try to compare this with something like a US stock market, or let's say an Indian stock market. Sensex will be a proxy for my stock market. 75,268 right now. Let's try and find out what it was in 2003. So I'm just calculating the CAGR, right, guys? I hope this is clear on your part. Okay, so it was around 3374 and it's grown up to 72,000. So again, the same exercise, 3374 and it's grown up to 72,000. Okay. This is roughly 17%. Now let's just compare. So this is the, so I'll just make it easy for you. This is for gold. This is for Sensex. And Sensex is the Indian index. So now we can take a more developed country index like a US index. So I'll take Dow Jones. This is basically this is like the Nifty or the Sensex of US. Okay. So let's look at this. 2003, it was around 8,400, 37,592. So this is Dow Jones. 37,500 roughly. Okay, so this has also given me 8%. So look at this. This is very interesting. So gold has given me 9% over the years. So this is CAGR. Okay, gold has given me 9% over the years. Sensex has given me 17%, and Dow Jones have given me 8%. So what are the observations from this? Firstly, Dow Jones is the index of a developed market. US is already a very developed market, and no wonder that the index of the developed market has grown at a staggered pace, 8%. On the other hand, Sensex, back in 2003, India is still a developing country, but India was a much less developed country than what it is today. So in the last 20 years, it has grown. The index has grown at around 17%, which is very good. Which is as a financial instrument, that's one of the best. But gold, on the other hand, has grown at 9%. So while gold has outperformed the developed countries index, it is significantly lagging to a developing country, which tells you that as an investment, gold makes sense when you have got the other investment opportunities shut out, which means that if you are in a developed country and if you think that your market is already grown enough where it's not where it's not going to grow at a significant CAGR, then gold becomes a safe haven for you in terms of offering you a stable pricing like 9 to 10%. But if you are in a developing country, then there is an opportunity cost, because you can use that same money to invest in the index, which you can say that is expected to increase at a faster rate. So right now, the kind of stage that we are in the Indian context, it makes more sense to invest in an index rather than in a completely in gold, because as I said, we are still in a developing phase, and as long as we continue to grow at this sort of pace in our economy, in our industry, then it is always better to invest your money in stock market than in any other avenues like gold. But however, you can always diversify your portfolio and put a part of it in gold. In times of recession or in times of economical turmoil, it will come into good use. But apart from that, for a long run perspective, if you're ready to hold in your money for a longer amount of period for the next decade or two, then stock market makes a better sense, or a better historical data set is present in terms of investing in stock market. Okay, so the benefits of investing in gold. Financial security is one, because again, no matter what happens, we've seen that gold prices always appreciate. Diversification, huge amount of advantage in terms of it's the kind of entity in your portfolio that whenever a recession strikes, all the other things will go down. Your bonds, your stock performance, everything else will go down. But this is the only security which will continue to give you handsome profits even in times of economic slowdown. And the long-term growth potential. So long-term growth potential, as we had seen, that for developed economies like our US, where Dow Jones has grown at 8%, gold will outperform it with 9.5, 9.6%. Now the risk associated, so volatility. So price volatility is one such thing. So tomorrow the gold prices can collapse if the all the economic indicators start to grow in sync. If all the economic indicators start to be smooth and the stock markets gets into a bull run, which it is currently getting right now, then gold prices tend to crash, because people tend to take out their money from all these gold instruments and invest more into aggressive instruments like stocks. Regulatory changes, is one such thing where taxation related to gold is very important in determining the prices. So tomorrow, if the let's say the government, so you guys must be knowing it that places like Dubai, the gold is cheaper as considered as compared to India. So there's also one more dynamics, that whatever the taxation is, if a country tends to tax higher on gold, then obviously the demand for gold in that country will increase, since the taxation rate is higher. So people will tend to start to import it from outside, or people will start to invest in gold instruments outside that country. A lot of people will probably buy their gold from Dubai according to the custom limits prescribed. So that increases the trade activities of gold in a country as well. And macroeconomic factors, that always remains in terms of interest rates, inflation, currency movements, which we just discussed, that remains in gold as well. Okay, so now let's come to taxation in India. So taxation will be important, because from a real life perspective as well, a lot of you will be paying. In fact, I guess all of you will be paying taxes in the next few years or so. So let's start off. But before that, just to clear it out, we talk about income taxes here, but in general, every one of you is a taxpayer, and we all are taxpayers in some sense, because the moment we buy a product in India, be it even a shampoo sachet as well, a certain part of it is always in taxes. Okay, so any product you are buying taxes, it's just that that's an indirect tax, that's not a direct tax, it's not an income tax. But in general, every single person who's buying any product in the economy is a taxpayer. Okay, let's understand. So, as I said, direct taxes such as income tax, which is directly levied by the government on the institutions, and most likely your salary and all will be directly, the taxes will directly come deducted at the source, which is called the TDS, tax deduction at source. While the indirect taxes are things like GST, which is affecting the price of the products, which is affecting things like petrol and diesel. So, just for your information, petrol and diesel are, in general, are quite cheap commodities. So, tomorrow, if all the taxes are done away with in petrol, you will probably get petrol for 40 to 40 rupees. But since the tax levied by the government is so high, both central government and state government, therefore we get it at what price we get. So essentially, any good that you go across, you will see will come under some or the other GST category. Now that I think will be a much more subsided discussion. So let's focus on the direct tax part, the income tax part, which will come into good use. Okay. So nature of direct taxes. So direct taxes are directly levied on your income or your profits, whatever it is. So as a salaried individual, you will get a salary, which is your income, which will be taxed, and then you will also have some personal finance decisions where you can earn profits. So, for example, your profits on your on your bonds, on your stocks, on your trading gains, whatever, on your property sale, on your other capital gains which you might have. Okay, so all of this come into direct taxes, and you need to report all these taxes at the end of the year to income tax department. Okay, so components of direct tax. So as I said, it is usually income tax, capital gains tax, but there's also something called corporate tax, which is applicable for the companies. And we'll also try to understand the impact of this on the individuals. Okay, so let's straight away get into the income tax calculation and explanation. Okay. Okay. So how does the income tax work? So income tax follows a progressive tax structure, which means that if I am earning 5 lakhs, I will fall under the 2.5 to 5 lakh bracket. But if I am earning 5 lakh 1 rupees, so the first 2.5 lakh to 5 lakh will be taxed in that particular tax bracket, and then the next part of it, the next amount of it, will be taxed in another tax bracket. So it's not like that that I am earning 10 lakhs and the tax for 10 lakhs is, let's say, 15%. So I have to pay 15% tax on the entire 10 lakhs. No. So first 2.5 to 5 lakhs will be taxed in a different manner, 5%. Then again 5 to 7.5 lakh will be 10%. So this is called progressive taxation. Each bracket will be taxed in a different manner. Okay. So we'll get on to the income tax brackets later. Next, we'll see that we also have income from various investments such as stocks, mutual fund, real estate. And then we also have something called wealth tax and capital gain tax. Okay. So this is the tax structure for old regime and new regime. So currently there are two types of regime, old regime and new regime. So under old regime, you have got the upper tax structure that refers to the old regime tax structure, which means that you are free to choose among any of the two. So assuming everyone is under 60 years, we'll look at only the under 60 years part. So in old regime, you will see that the taxation up to 2.5, 2.5 lakhs is nil, while in the new regime, it's up to 3 lakhs. Okay, so the old regime basically gives you the advantage that you get certain deductions, okay, in old regime, which you don't get in new regime. So in new regime, what happens is, if you are, no matter what type of deductions you are having, no matter in what way you are spending your income, you will be taxed according to the given structure. But in old regime, your net taxable income is not your salary. You will get certain deductions on that, and then you will have to pay taxes on that deducted amount. Now, what are those deductions? We'll look at it one by one. Okay. So, the first deductions are Section 80C deduction, which is the deductions that you can claim on your PF contributions, on your life insurance premium, on your tuition fees, on your taxable income. There's also this on housing loan interest, and there's deduction on medical expenses as well. So I'll come to it one by one. Let's see the deduction and let's see what is the limit for each deduction. Okay, so first is the standard deduction, which means that whatever you're earning, you will get a standard deduction of 50,000 on it. Next is house rent allowance. So house rent allowance is basically the rent that you are paying. So you are allowed to have a tax deduction on the amount of rent you are paying. But there's only one condition, which means that this has to be the minimum of it, the cap for it is it has to be the least of the actual HRA that the company is giving you, or the 50% of your salary for metro cities, or 40% salary for non-metro cities, or the rent paid minus 10% of your salary. So it has to be the least of the three that you can claim. So you can't simply go out there and claim that okay, my salary is 1 lakh and I'm paying a rent of 80K in my home. You can't do that. Okay. So for metro cities, the maximum you can do is 50% of your salary. So this part, basically you will get whatever rent you are paying if you can show the proof that okay, this is the rent agreement I have had with my landlord, and this is the rent receipts which I have. If you upload the proof on the income tax portal, then you get a tax cut on that particular amount. Okay, next there is deduction for home loan interest. So if you're not having a rented house, if you're living in your own house, but if you're paying a interest on your home loan, and a lot of people do this for uh, tax saving as well, that they take a property and then pay interest on that. So for home loan interest, you have a deduction of rupees 2 lakh per annum, but be careful that this deduction is on interest and not on the principal amount. So if I am paying let's say I have a home loan of 20 lakhs and I have an interest rate of home loan interest rate of 10%, which means that 2 lakh is the interest I have to pay. Now this 2 lakh interest is exempted from taxes. Okay. Now reduction for principal payment. So principal payment is basically 1.5 lakh principal is what you will get an off on, but be careful that this is on the section 80C. So section 80C, I'll come to it differently. There are a lot of things to cover in section 80C which you can do to save. So basically 80C tells you that you can save 1.5 lakh rupees by investing in any of the above instruments, which are PAF, PPF, NSC, LSS. Now what are this? I'll come to this one by one, and what do they do. Next is medical insurance. Medical insurance. So for us, for individuals who are 20 to 60 years of age, we can claim up to 25,000, and for senior citizens, it's around 50,000. Okay. Now the education loan interest. If you have taken an education loan, then there is no particular interest limit on it. There is no specified limit. So whatever interest amount you are paying on your education loan, the entire amount is tax exempted. Then there's ATC, which is basically the section for donations. This usually refers to any charitable donations you have done, but this has to be, but the uh, organization that you're donating to has to be registered under ATG. Okay, so make sure that if you're doing a donation, then you ask the organization before that it's whether it's registered under ATG or not in order to get a tax exemption. And if it is, then you can upload the organization's ATG proof along with that and claim the tax deduction at the end of the year. For disabled people as well, you've got 75,000 for 40 to 80% disability, and for more than 80% disability, you can claim another 1.25 lakh tax exemption. For interest that you are earning on your savings account, which is the 80TTA, you will get 10,000 deductions. And for income from house property, so if you are earning as a landlord, if you're earning from your own house property, then you can get a deduction of up to 2 lakh rupees. And transport allowance is also 19,200 per annum. You get a deduction. Okay. So now I was talking about the 80, the section which I was referring to here, 80C. So this is basically the 80C tax options. Okay. The first is ELSS. So ELSS is equity linked savings scheme. Now, what happens in equity linked savings scheme is you basically pool this is more like a mutual fund where you pool in your money, some part of your money to this equity linked schemes, and they invest in equity. So they invest in stocks for your, so these are usually basically the long term, the large and the mid cap stocks for your long term wealth creation. But the only catch of it is when you're investing in ELSs, there's a lock-in period. So whatever money you're investing, unlike mutual funds, you can't get this money back for 4 years or whatever the lock-in period is. Okay, but people use it because they are a tax-saving option. Next is the public provident fund. So public provident fund is another fund which gives you the long term interest rates, and this PPFs usually invest in. So the rate for the PPFs vary according to the government discretion. So the government tend to increase and decrease the PPF rates accordingly, but usually it is north of 9%, and you get really good returns on this. And again, this is also the fact that the government is paying on it, so PPFs usually tend to be a very safe investment option. There's no chances of default and stuff, so you can go for this as well. And then there is NPS, the National Pension System, which is basically TCCD. And in National Pension System, you have got three options. So you can either tend to be a defensive investor, or a mid-risk investor, or a aggressive investor. So if you are a defensive investor, then most of your money under the NPS scheme will go into government bonds. A small part will go into equity and corporate bonds. If you are a medium term investor or a medium risk profile investor, then the money will almost be equally distributed among the bonds and the stocks and stuff. But if you are a high risk investors, then most of your money will go into equity. 65 to 70% will go into equity, and the rest will go into corporate bonds, and a very small amount of it will go into government bonds. So the NPS, whenever you open an NPS account, they give you an option to choose the kind of scheme that you want to go for. My advice to you would be, at a younger age, always try to go for an aggressive scheme. But as your age increases, you might shift your focus towards more defensive instruments. Okay. So now coming to the tax planning part. Now salary. So always try to restructure your claim, and restructure and claim all your deductions. So as I said, from ATC you can claim 1.5 lakhs. The standard deduction is 50K, 2 lakhs. If you have any interest rates on your house or on your education loan, claim that as well. And then you have also got the HRA. So if you are staying in a rented place, if you're away from your home, and your office is in a different city, then you can also claim that HRA. So overall, you will get to save a significant chunk of your salaried income from tax exemption if you use all the sections wisely. And also in general, investing in PPFs and NPS or ELSs is a good scheme because it also increases your savings. In some sense, it forces you to save your money as well. Okay, so so for tax planning, always remember that you make a record of whatever you are whatever investments and whatever claims you are making throughout the year. So that at the end of the year, when you are, so basically we have to, usually the deadline for filing taxes is June 30th, and for the previous financial year. So whenever you are filing your taxes, make sure to keep your proofs handy, whatever investments you have made throughout the year, your rent agreements, your rental receipts, or your education loan interest payments. Keep them in a safe place, keep them in a safe folder, and upload all of those proofs as and when needed. And also keep a record of what type of tax saving plans you are making, because some of the plans, for example an NPS, if you are doing it under the tax saving scheme, then the money that you're investing can only be taken out when you're 60 years of age. So it's important to keep a planning and a record of how much you're investing into that. Okay, since you'll be investing in 24 years of age, and then the earliest you can get it back is 60 years. So keep a record of that, right? So again, this is not really this is a kind of an additional part. It's not really applicable for you guys. For business owners, whatever tax planning you can go through. Uh, wouldn't like to focus much on this because again, it's unless there are some entrepreneurs among you, then there are ways by which you can you know increase or decrease your business tax. So for example, you can there's something called a depreciation of assets. So if you show your depreciation of assets in a faster manner, the depreciation expense basically in a faster manner, then you can the tax, the profit before tax that you have on your business can be shown as less, and therefore in the shorter run or in the current year, you have to pay lesser amount of taxes. Okay. So these are small subtle ways. Or if you're running a business, if you're in let's say if you have a proprietary firm, then you can show your certain home expenses. For example, let's say someone is in a business of prop form of trading. Okay. Then you might also show your home electricity bill, or your home internet bills, or the purchases you're making on gadgets as your business expense. Or you're traveling to a certain place, then you can show it as a business expense, and you can claim your tax deduction on that particular part. So that's how you can, as a entrepreneur, you can combine both of this, your business and your personal accounts, and get some tax deductions there. So there have been recent changes in tax laws. So the new, as I showed you, the new regime system has come into play, and always stay updated with all the regimes. So again, the budget will come this year as well on February, and make sure that you go through the budget and you check out the new regime. So because every year there is some sort of change in the tax structures. So right now, in under the new regime, the up to 7 lakhs there is a deduction. So you don't have to pay your taxes up to 7 lakhs worth of income. So stay informed and stay updated about that. And there's always a question on whether to uh, take new regime or old regime. My answer to that is simple. You have got the tax slabs with you, so make sure that you calculate it. If you are having enough amount of deductions under the old regime, so let's say your income is 16 lakhs per annum, but if you have like a deduction of two and 3.5 lakh, 4.5 lakh under your old tax regime, then just calculate according to the tax slab structure that what is the net taxable income you're having. Take an Excel sheet and do the old regime calculation and the new regime calculation, and just find out that whatever is suiting you. Okay. So my take is that for any income below 18 lakhs, a new regime would make sense unless your deductions are above 5.5 lakhs, which is very unlikely. And for anything above that, with deductions, an old regime would make sense. But anyways, just to confirm out your exact details, always take an Excel sheet and you have the two tax slabs ready, and do the calculation accordingly. Thank you so much for being so patient. Now I'll go on and take your questions one by one. I have a question here. Are SGBs? So Shivam Sagar is asking, are SGBs backed by physical gold owned by the government? If so, is there a limit to how much they can issue? Look, Shivam. Okay, so yeah, SGBs are backed by physical gold. Yes. If there is a limit to how much they can issue, yes, there is a limit as well, of course. But the good thing about the gold part is that RBI has a lot of gold reserves. So essentially, for us, the government doesn't even test 1 or 2% of the limit. So whatever issuance that's happening around every month, you can be pretty assured that it's not even testing a little bit of the limit, because in any case central banks will have to maintain their gold reserves. So RBI also has a gold reserve which is used for multiple purpose, and SGB is just a very small among them. The major use of gold reserves is for maintaining the stability of your currencies, the Indian rupee. So yeah, therefore we have a very stable gold reserve and we do maintain that, and SGBs form a very small part of it. Okay. What does it mean when someone says currency X is pegged to dollar? Okay. So, Manas, basically there is a uh, concept of a floating currency and a fixed currency. Okay. So, for example, the Indian rupee is a floating currency, which means that we do not decide what the value of the currency is. We do not decide that okay, aaj 1 rupee is equal to this much dollars. Rather, we let it float, which means that rather we let the market decide. The forex, the foreign exchange decide. Okay, so basically, in the demand supply, the currency will itself find the price. So, for example, if someone thinks that the rupee is undervalued or overvalued, they will buy or sell the Indian rupee on US dollars on the foreign exchange market, and that's how it will be. But there are some currencies which are pegged to the dollar, which means that it is predetermined by the government of that or by the sovereign that our currency is equal to this much dollars, which also means that they would have to maintain. So for their government, if they want to issue more money, okay, then they will have to maintain an equal amount of dollar in their reserves. That's what it is meant. So before the advent of 1960s, the gold, there was something called the gold standard, which means that the dollar was pegged against gold. The US could issue only as much US dollars as they had gold in their reserve. Okay. Does China does the same? Yes, China also does the same. Yes, Chinese yuan is also not pegged to any currency. It is also same as the Indian rupee. It is on a floating exchange rate, which means the market will decide key what is the value of that. You can say that pegged currency would be something like a Saudi Arabia. Okay, Saudi Arabia has pegged its currency against US dollars. So the currency of Saudi Arabia is Saudi Riyal. You can see that Saudi Riyal is pegged against US dollars. So no matter what happens, that will remain the same. Any other questions? Okay. Thank you so much. Thank you so much, everyone. Really happy to connect and guide you guys. So if you have any other questions, you can reach out to me directly on LinkedIn. I'm sure I learned a lot because in terms of while making this as well, I had to revise my concepts as well, and I tried to make it as lucid for you guys as possible. And thank you so much for taking out time on a Sunday evening and listening to all this. Thank you, everyone.
Thank you, sir.
Yeah. Bye.